Hi, I'm Patu from freefincal. Let's take a look at PlumbLine for the first quarter of 2020 in this video. Wish you all a very happy 2020. I hope it's calm, quiet, and pretty much uneventful. I hope you made your resolutions for 2020, and I hope at the very least, like I've said before, the single most important resolution that you should make is avoid processed food, and all forms of sugar. So before we get to PlumbLine, which is my handpicked set of mutual funds, I've been talking about launching this goal-based portfolio management course. There is a sign-up form. I will include the sign-up form in the description and also in the first comment. This course is a video lecture. I had, if you look at yesterday's video, I had given you a list of FAQs. I'm not going to go through it again. If you sign up for this, I will intimate you when the course is launched. You are eligible for a 60% discount of the price. So the price will be 2,500 rupees plus transaction fee. So 60% of that is 1,000 rupees. So that's the cost. It's a one-time fee. It's not a recurring fee. It's a one-time fee for accessing the videos. So you can sign up for this in the Google Forms link in the description or in the first comment. So that's that. Let's get to the handpicked list of funds. This list of funds was made as an accompaniment for my robo-advisory template. It will work only when you have a clear need in place. I think most people do not understand the motive behind PlumbLine. They keep asking, why not this fund? Why not that fund? Add one more fund in this category. Why not that category? I mean, I'm not here doing this to validate your choices or trying to offer one fund in every category. That's not the point. It's need based, and if there's no need for that category, it's not going to be there. All right, so let's get to it. There's a big disclaimer. I want you to read the disclaimer. I'm not going to go through it. It's painful to do it. Overnight mutual funds. We'll start with overnight mutual funds. So the first one is Lnt Cash fund. This is an overnight fund. It will invest in bonds that mature overnight, so its portfolio will essentially change every day. The interest rate risk is low. The interest rate risk is pretty much absent. The credit risk is marginally, it's non-zero but marginal. It's just for parking funds like a savings bank, so you should know what to and how they work. And the AUM of this fund can fluctuate up and down wildly, but that's something that you should get used to. In the liquid funds, you can use Quantum Liquid Fund because it doesn't take any risky bond exposure. Of course, the expense ratio of Quantum Liquid is marginally high. I think they should lower it down if they want good AUM. Otherwise, you can stick with ICICI Liquid or HDFC Liquid fund because the AUMs will be high. The exposure to risky bonds, even if they take that risk, will be low, and also they have a reputation to defend because these funds will invite HNI money, because of that they will make sure they don't screw that up. So you can consider those as well, but just have a look at the portfolio before you invest. So this is the portfolio of Quantum as of November 2019. You can see that's the kind of bonds it holds: banks and sovereign bills and so on. In the arbitrage section, I recommend the ICICI equity arbitrage. I'm invested in it. I'm invested also in Quantum, although the exposure is quite small. My exposure is significant. I am invested. My wife also has a separate portfolio for a different goal in this and so on. It doesn't take on risky debt. It can have a little bit of direct stock exposure, but it tends to avoid that, so it's okay. There are risks in it, but use it for more than 1 year. Overnight fund, you can use it for a few days. Liquid fund, use it for a few months and more. Arbitrage funds, 1 year and above, and so on. You should know when to use what. Ultra short term, low risk. It's a money market fund, Franklin India Savings Fund. It's a very rare fund in the Franklin debt family, where it takes on marginal, and the credit risk is very low. The lowest. Does take on, there is credit risk, but it's the lowest among all Franklin funds, and you can use it for 1 year and above durations. So it's a fairly decent fund. If you want to take on high risk above 1 year, take the bull by its horns, Franklin Ultra Short Term Bond Fund. Well, whether the Vodafone Idea bonds default or not, it doesn't matter. The risk is always there. but you should understand the risk. If you understand the risk, then you can play the game. So the problem is people look at 9% returns from this fund and invest assuming nothing will happen. That is stupidity. But if you should understand what is the kind of risk, and the risk is pretty huge here. All right, so that's that. You can see this fund has 13 bond the credit ratings of 13 bonds has been downgraded in this year. So it's pretty much an everyday event for this fund. So you should be ready for it. I have removed one fund, a medium duration fund. I had recommended Franklin India Income Opportunities Fund, but then that had 15 bond downgrades. And from the time I started recommending it, the credit rating had kept on going down. So I decided to remove that category. So that's a confusing category. I didn't want to include it. Corporate bond, Franklin India corporate bond, it will have about 60% of AAA rated AA plus and above rated bonds, but the rest will have low credit quality that can default and that can have credit downgrades, and they have I mean, this fund has seen credit downgrades in Reliance Broadcast Network, Piramal Finance, and Jindal Power, but they are a very small exposure. Still, it is still there. Use it for long term, 5 years and above only. So if you want to play the high risk game for long term, then Franklin India Credit Risk Fund, it's an amusing fund. It used to be called Corporate Bond Opportunities Fund. Its AUM has not grown so much because people have gotten scared of this fund, but it will invest in very low quality AA and below. So you have to be really careful with it. I mean, I don't know. There are 27 bond downgrades for this fund in 2019. So that's probably a record. Look at the now. Look at the now, up, down, up, down, up, down, and it just keeps going. And so it's you got to be careful with it. If you want a fund that does not take on any kind of credit risk, is kind of constant, the interest rate risk is also fixed to one particular 10-year bond, then you can use the SBI constant maturity bond. But do not use it for short-term goals. Use it for long-term goals. Use it as part of a long-term portfolio. Rebalance properly. Then this fund will work. Otherwise, it's a problem. There is another fund, I think ICICI Constant Maturity also is a decent pick. It has got a lower expense ratio, 0.17% compared to 0.33 for the SBI fund. Other gilt funds or dynamic bond funds, I'm scared to recommend dynamic bond funds because they're pain in the ass. It's difficult. And other gilt funds, it's heavily dependent on fund manager. If the fund manager gets it wrong, then the gilt will be a problem. In the 10-year gilt, the fund manager risk is pretty much not there because this is an index fund kind of gilt option. In the tax planning, they've been very good in terms of, I've checked using the screener, my monthly screener, and the consistency of outperformance has been good. What is the index I use? Nifty large mid cap 250. So they have done quite well. So you can use it if you need it, and so on. I don't recommend using ATC. Parak tax saver fund is an option that you can consider. It should be similar in style with the Parak long-term equity fund, except for the international exposure, because ELSS funds cannot have international exposure as far as I know. It should have 80% of Indian equity. I don't think they will have international exposure. Balanced funds or aggressive hybrid funds, HDFC hybrid or HDFC balance, Franklin India hybrid, and ICICI equity and debt fund. Those are my recommendations. I'm keeping an eye on Franklin and the HDFC fund. I want to see how they perform. But they kind of track the Nifty. I've shown the last 1 year performance here. Yeah, you can see here, that's the Nifty in red. It's very hard for you to see probably in this kind of color graphs. They have kind of tracked the Nifty close to it. They won't exactly match up to Nifty returns, but they keep track of it reasonably well. That's good enough. At 65% or 70% equity, they're able to track the Nifty. I would buy that. ICICI fund has got a good track record. The equity and debt fund has got a decent track record. So multi-asset, my favorite, ICICI multi-asset, also called ICICI Dynamic previously. I just made a review video. I just talked about it a couple of days ago. And I also recommend it for first-time investors, as you may know. I use it, as you may have heard in my audit. So that's a good fund. Multi-cap, I would recommend large mid-cap, multi-cap. There's no point differentiating this. I just recommend Parak. I'm really invested in this. I used to have quantum long-term equity, but then they just I mean, I gave up on them. It's too hard for newbies. Older investors should be careful. I have disclosed that I'm reducing my exposure to quantum long-term equity. Newer investors should avoid it. I think they just cannot, they have to react to changing markets. If the markets are changing and if you're benchmarked to the Sensex and if only a few Sensex stocks are moving up, I mean, you can't say I mean, how long will you say I'm going to stick to my mandate and underperform for years and years and years? If you're going to underperform, then you better reduce the expense ratio, right? I mean, you can't have your cake and eat it too. That's just not going to happen. Then come the index funds. If you want just the Nifty index fund, you can choose the UTI fund. There are other funds. Uh, Nifty is a good option. HDFC Sensex, DSP Nifty, equal weight is an option, but you got to be very careful. You got to be. This can be extremely high risk. If you notice, I just showed how the Nifty equal weight and the Nifty 50 have deviated. But be very careful while choosing equal weight indices. I kept it there, but I'm not so sure it's a good option for most people. Just stick to UTI Nifty index. Then you can have an index blend if you prefer. You can have a you can consider a large mid cap, that is you can have 50-50 of UTI Nifty next 50 or ICICI Nifty next 50 plus a Nifty Nifty fund. 50% of Nifty fund and 50% of Nifty next 50. That's one option. It's up to you. You can choose it in different proportions. That's one option. You can what I mean is that this would you can just have Nifty next 50, but that would be too high of a risk, so you have to blend it in some way. So there are different ways you can blend it. You can have 50-50 of Nifty and Nifty next 50, 80% of Nifty and 20% of Nifty next 50, and so on. Those blends are a possibility. But then if you don't want to do this blending, then you can choose simply the Axis long term. I mean, sorry, not the Axis Nifty 100 index fund. Sorry about that. Having Axis Nifty 100 index fund. Just that then you don't have to worry about this